Well, hello everyone. I'm Matt Kosonen from Ellis & Associates Wealth Management. Thank you for joining us and welcome to our first webinar in a new series on capitalizing on opportunities available now. Today's call should last about 20 minutes and I will be moderating while William Ellis will be our presenter. Please type any questions you have in the chat box during the session and we will address them in the time allotted at the end. The webinar is being recorded and we will send you a link afterwards so you can view anything you miss or to pass along to someone who might benefit from listening. We will also post on our website where you can view it at any time. You can also view our first webinar series on planning strategies for volatile markets on our website in our content library. Our session today has 4 sections. The first is a look at things outside of your control as an investor. The second answers the question of why invest now. The third is a quick look at current opportunities. And finally, in the last section, William suggests how we can imagine a different future. William, before we take a look at current opportunities and assist investors how to imagine a different future, could you run through things our clients, and everyone for that matter, have little to no control over?
Sure. When it comes to investing, most things are outside our control. Take your pick, be it inflation, taxes, interest rates, the economy, or corporate profits. We have absolutely no control over these factors. We are not left completely helpless, however. Although the economy is outside our control, we are able to anticipate and prepare our finances for the economic environment. And there are areas of our financial lives we have more control over, like our saving and spending, and how we behave as investors.
William, how should investors behave now? Should they be investing?
Well, there are things investors should be investing in right now because the price, the biggest determinant of investment returns, is right.
The price is right?
Yes, the price is right for certain investments. On the other hand, the price is totally wrong for other investments. 3 things drive investment prices lower: high uncertainty, a below average outlook, or widespread panic. And right now I'd say that we have 2 out of 3 of these things. What is missing is the widespread panic we saw a few years ago. As a result, prices are not as low as they were, but prices, which again are the biggest determinant of returns, are still at levels in select opportunities that make for attractive investing. As with any purchase, there is a trade-off between the price paid and the value received. And in my opinion, the current market price of select investments is attractive enough to more than offset the uncertain and weak economic outlook.
So now on your screens is a look at 2 areas that we currently see as good opportunities. We've talked about them before in a previous webinar series, but how do they relate to why invest now, William?
Matt, these are the estimated market yields for our dividend portfolio and our growth portfolio. They are somewhat lower than they were last summer, but the terms are still good for investors committing capital. The businesses in the dividend portfolio are recognizable, well-known Canadian businesses, many that we do business with every day. Profits and free cash flow of these businesses are growing 5 to 7% a year, lower than perhaps we'd like. The slow economy has had an impact, but nevertheless, there is growth, and profit and cash flow is growing faster than the rate of inflation, which we like. And you can buy these businesses currently at prices that pay dividend income at 4% a year. What you don't see in the dividends received are the additional earnings of approximately 4%, which the businesses earn and retain instead of paying out to shareholders. But make no mistake, the retained earnings you don't see are every bit as valuable as the dividends you see and that are credited to your investment statements. These retained earnings are used by the businesses to pay down debt, to fund business opportunities, and repurchase shares. All of those actions are expected to increase earnings in the future. If we are correct, with some regularities, dividends will increase as we've seen in the past, and unrealized capital gains will increase too, but as in the past, when stock markets cooperate.
And what about the second opportunity?
Well, the second opportunity is in the growth portfolio. Growth companies are growing faster than the dividend portfolio. They're growing 7 to 9% a year, and the estimated market yields are even higher than dividends portfolio at just over 10% a year. Very decent investment terms. We can buy these growth businesses at such attractive prices because they lack the yield that the market demands right now. So to answer the question you posed, Matt, why invest now? The answer is because the investment terms are attractive.
Now, William, can you take us through the exercise of imagining a different future?
Sure, Matt. This is a busy chart. I apologize for that. There's a lot going on. The orange dots plot the prospective, the looking forward 10-year compounded investment returns on the left axis versus on the bottom axis, the price-earnings ratio at the start of the 10-year period. And if we focus on the orange shaded box, this illustrates what the 10-year compounded returns were when the price-earning ratio was low. Okay, to the left, on the bottom axis, low price-earnings ratio. You'll notice that the box is drawn on the top of the earnings measure on the left-hand side, so it indicates that except for 3 10-year periods that started in 1938, 1940, and 1957 that are below that orange shaded box, the investment returns have been higher than 10% a year compounded when the starting price-earnings ratio was low. The starting point of many of those 10-year periods were pretty bleak times. Out of that orange shaded box, if you look closely, you can pick out years like 1941, 1942, 1944, years during the Second World War. You can pick out 1950, which you may not recall, but was a post-war recession. Or the years of 1974, 1975, 76, 77, 78, all of those years during the OPEC crisis. And on the top left, 1980, we may remember the beginning of a very deep recession as Fed Chairman Paul Volcker raised interest rates dramatically. All of those crises on their own right. We've been through crises before. Each is unique and in some ways unprecedented, just as the current economic crisis is unique and unprecedented. I think the takeaway from the slide is that the current market price, indicated by the orange dotted vertical line that plots down through the middle of this slide, equates to decent investment returns over the next 10 years. And I might add that our Canadian dividend portfolio and our growth portfolio are both priced much more attractively than the market in general, meaning to the left of that orange dotted line, suggesting even more attractive terms to their investments.
So after taking us through that chart and the numbers, William, can you give us some insight into what you mean when we say imagining a different future?
Well, you don't get something for nothing, that's for sure. By that I mean that the timing of investment returns and the amount of returns are uncertain, and there are no guarantees. But history has shown that the outlook is often not as bad as we are told, or as we even imagine. I would like to challenge investors to imagine a different future, to imagine that the sun will shine tomorrow, Or that if the sun doesn't shine tomorrow, the sun will shine the day after tomorrow. We are going through a dark period economically. We get that. And I want them to imagine that we might just muddle through and come out the other side, just as we have done many times before. And I would encourage investors to focus not on the economic or business outlook alone in isolation, but to focus also on the price, which is the biggest determinant of investment returns, and focus on price in relation to the estimated market yields that are on offer right now.
And finally, a slide we refer to in some sort in almost every one of our webinars, and almost every meeting with clients for that matter, are estimated market yields. Instead of a rundown on what's available now for investors, William, take us through how this shows the uncertainty in the marketplace and how investors can capitalize on that now.
Well, the contrast is very stark. The interest rates available are at or are near all-time low levels, reflecting a continued flight to the perceived safety of bonds. Whereas the market yields available on select equity investments are priced with market yields of 7 to 8 for the dividend portfolio or 10 to 11 for the growth portfolio right now. Very decent. And you'll note that in each case, those earnings are growing at a rate faster than inflation. My view is that the price is right for select equity investments.
And what about for bonds?
Not at these prices.
Okay. Well, we will now begin to answer questions from the chat. And one that I have here, William, is why invest now if the price may be lower in the future?
Well, that's a really good question, and it's one that investors struggle with. We all want to avoid regret. The regret, say, of paying too much. And since, as we said, price is the biggest determinant of investment returns, investors want to get the best price possible when making an investment to enhance the returns. Let me give you an example of how we can feel regret. Let's say that we are renewing a mortgage and lock in a mortgage at 3.09%. And we're very pleased. I mean, this is close to all-time record lows. And then imagine the following week, the bank announces a sale of 2.89% for 5 years. Of course, to some degree, we're going to feel some regret. It's important, however, not to lose sight of the fantastic 3.09% rate that was locked in. Likewise with our dividend portfolio and our growth portfolio. Currently, we're able to lock in good dividend and market yields at prices that over the coming years should reward us as owners very nicely. Perhaps if we wait a month or if we wait a year, we can purchase shares on even more attractive terms. Even if that happens, the dividend market yields that we lock in at today's prices are still very attractive and still be rewarding us as investors, even if we don't lock in the lowest rate possible. And therefore, that's why I would say we should go ahead and invest today.
Thank you, William. And if there's no more questions, thank you for joining us today. And if you'd like to discuss today's webinar further, please feel free to contact us at 416-969-3190. Thank you, and I will now end today's session.